When will this cycle end? That's a big question on everyone's mind, and that's what we will address today. Welcome to another Bitcoin Intelligence video. We are reviewing report 22 today. My name is Sina. Today is Monday, July 28th, and let's get into it. So we have our 20-second report ready to be emailed to our subscribers, and I'm recording this video to be added there. The report is titled, When Will the Cycle End? We discuss, as always, a combination of economic and on-chain data. So we will first discuss some cycle navigation models and where we are in the cycle and how likely it is that this cycle might end soon, or essentially when will it end. Then we look at on-chain data, and we look at selling behavior of short-term holders and long-term holders, ETF accumulations, and some of the price bands where heavy accumulation is happening and where potential support zones and air gaps exist. Lastly, in our monetary mechanics section, Renault looks at the important events that are happening with the Fed and the attack campaign that Bessent and Trump are waging against Powell to get him to drop the rates, as well as TGA refill dynamics and the stealth QE that Renault discusses. All right, so moving to the first part of the report, which I want to discuss in this video. And again, we have each of our sections, including on-chain and monetary mechanics, have their own video clips. If you want to access all that together with the full report, you need to join Bitcoin Intelligence from 21stcapital.com/BI. All right. So when will the cycle end? Now, the way I will answer this, and really simplify this, is by mentioning or painting a picture and a mental model about bubbles. Essentially, my point in this discussion is bubbles form when price runs too fast. How do we know it's too fast? When it is much faster than the long-term trend. How do we capture long-term trend? Bitcoin quantile model captures that. You can find live charts for this on our platform. And it is a curve, obviously, on a log chart. On a log linear chart, and the curve is capturing the channel that demonstrates the long-term trend that Bitcoin has been following in the 15 or so years since 16 years since its inception. And that trend has a particular slope at any time. And when price moves up much faster than that, then we enter bubbles. Why is that? Because the long-term trend shows how fast actual capital and actual human beings are adopting Bitcoin and how fast the network is growing. Price can appreciate faster than that for a variety of reasons, including hype, reflexivity, temporary supply shocks where for a period of time too many people are trying to buy on exchanges and there aren't many coins yet. And for all these reasons, the market might be very thin and fragile, and a little bit of a buy pressure could lead to massive price appreciation. But these are not sustainable, right? And a super simple way to measure that is to see how fast the price has been appreciating compared to the long-term trend and how deviated the current price is from what the trend would suggest. This is exactly what the Bitcoin quantile model does, and it captures the risk score, captures all these dynamics into a single number, the risk score or current quantile, that goes from 0% to 100% and shows us the risk level. Right now, that number is at 68. When it gets to 80, that's the risk region. When it gets to 90 and more, it's the danger region where we have always topped in the past. But generally, anything above 80 is in the hot zone, basically. Now, if you look at cycle one, you see that we topped. Essentially, we entered a bubble when the price began rising too fast and faster than the long-term trend. In the second cycle, same thing happened. This yellow region, for example, is a good gauge of the long-term trend slope, but the price initially moved much faster than that, then crashed, then moved faster, then crashed, then spent the bear market exactly following the long-term trend, except in the lower level, but their slope is the same. In the beginning of the third cycle, price began running too fast, way faster than the long-term trend would suggest. And again, it was not sustainable. Once it reached the danger zone, it crashed. Then we spent a year or two, more or less, following the trend. And then the fourth cycle began. Price ran fast, way faster than this channel would suggest. And of course, it was not sustainable. It crashed once, crashed another time, spiked another time, and then crashed again. Then it spent more than a year in the purple region following the exact trend. So when this happens, price might appreciate, but um, risk does not, because appreciation is exactly matching the speed of long-term adoption. Then we initially got a fast appreciation after ETF approval, and all the stuff with BlackRock and friends took us from the bottom of the bear market to a new all-time high. And then that was obviously faster than the average trend. We did correct back down, and we've spent pretty much all of our time since then in that green region. Just recently moved to the yellow region and trying to stay on the boundary. But overall, roughly speaking, last 2 years has been just Bitcoin appreciating in price. If I get closer, appreciating in price, exactly following the trend parallel to the sides of this channel. So price has appreciated, for example, from 70 to 120 here, but risk has not. So valuation is the same. All the price appreciation has been just following the same trend, and no bubble is visible here, right? If Bitcoin begins running fast and gets to, say, by the end of the year, for example, gets to 200 or 300, that would give us a really steep slope. That would be much faster than the long-term trend, and that's a great indication that we are entering a bubble. And these people who are on social media saying that, okay, this year I'll see $1 million, then the next year I'll see price reaching to crazy levels. These people are asking for something that they won't actually like, because if in a very short period of time Bitcoin jumps to $1 million, okay, everybody would love that, all the excitement and everything will happen, but I guarantee none of you will be able to time that top. And essentially, what will happen is you lose the opportunity to accumulate at low values, and Bitcoin will go to crazy numbers, and people will FOMO in very late, and then price crashes. So you actually end up being in the red. And this wouldn't be something that anyone likes. We actually want methodical, slow, fundamentally driven growth a lot more. But psychologically, a lot of people love to see massive candles. But candles that are not sustainable are actually not a great thing, especially if you are a long-term holder. And primarily, the function of promising nonsensical price values is to hype it up, gain attention, gain some more media time, and inevitably hurt everyone else, and especially the retail investors. But that being said, this is going to be very helpful in gauging the risk in the market. So you can see if price really appreciates from here, you can exactly, at any point in time, you can exactly tell how much the risk has increased and what's this risk score. And again, for example, if by the end of the year we get to 200K, that would be our 90th quantile, meaning the risk has risen to 90%. That would be pretty risky. But so far, seems like this cycle we are going much slower. So we essentially following the long-term pattern, and price goes up, risk does not. All right, so that's a wonderful thing. The rest of the report quickly touches upon a metric that we can extract from all this. Essentially, if we get all these quantile values for every day during Bitcoin's lifetime, we can extract a metric like this that again goes from 0 to 100%, and then that would perfectly match the tops and bottoms. And right now, it's a little bit warmish, and again, once it gets hot, we will be surely highlighting that for you. The next part talks about how we absorbed the $9 billion sell pressure last week, and the market showed extreme resilience.